Welcome back to our valuation series. In our previous capsule, we explored reverse DCF analysis, which reveals what growth assumptions are baked into current stock prices. Today, we're zooming out from individual companies to examine the entire market through the lens of Robert Shiller's Nobel Prize-winning innovation, the CAPE ratio. CAPE stands for cyclically-adjusted price-to-earnings ratio, and it's one of the most powerful tools for understanding whether the overall stock market is expensive or cheap. While regular PE ratios can be misleading during economic extremes, CAPE smooths out these distortions by looking at 10 years of earnings data. Let's start with the problem CAPE solves. Imagine it's 2009, right after the financial crisis. Corporate earnings had collapsed, making traditional PE ratios look artificially high and stocks appear overvalued. But anyone buying stocks then made fantastic returns over the following decade. Regular PE ratios failed because they captured a temporary earnings collapse, not the market's true valuation. This is where Shiller's insight becomes brilliant. Instead of using just 1 year of earnings, CAPE averages the previous 10 years of inflation-adjusted earnings. This smooths out the peaks and valleys of economic cycles, giving us a clearer picture of what the market is actually worth. Here's how CAPE works. First, take the current market price. For the S&P 500, that's today's index level. Next, calculate the average earnings over the past 10 years, adjusting each year for inflation. Finally, divide the current price by this 10-year average. The formula is simple. CAPE equals current price divided by 10-year inflation-adjusted average earnings. Let's walk through a real example. In early 2000, during the dot-com bubble, the S&P 500 CAPE reached about 44. This was nearly 3 times its historical average of around 16. The ratio was screaming that stocks were dramatically overvalued. Indeed, the market crashed shortly after, and it took over a decade for stocks to reach new highs. Contrast this with March 2009. While regular PE ratios looked scary due to collapsed earnings, CAPE showed a reading of about 13, well below its historical average. This suggested stocks were actually cheap despite the panic. Investors who bought based on this CAPE signal enjoyed exceptional returns as the market recovered. Why does this 10-year smoothing work so well? Economic cycles typically last 5 to 10 years. By averaging a full decade of earnings, CAPE captures companies' true earning power across different economic conditions. It sees through temporary booms and busts to reveal underlying value. CAPE isn't perfect for timing short-term moves. The ratio can stay elevated or depressed for years. During the late 1990s, CAPE suggested overvaluation for several years before the crash finally came. Similarly, after 2009, CAPE indicated cheap valuations for years while stocks kept climbing. However, CAPE excels at predicting long-term returns. Research shows that when CAPE is high, subsequent 10-year returns tend to be low. When CAPE is low, the following decade usually delivers strong returns. This relationship isn't guaranteed, but it's remarkably consistent across different time periods. So how should you interpret today's CAPE levels? As of recent readings, the S&P 500 CAPE sits around 30, nearly double its historical average. This suggests that long-term returns may be more modest than the historical norm. However, this doesn't mean an immediate crash is coming. Several factors could justify higher CAPE levels today. Interest rates have been historically low, making stocks more attractive relative to bonds. Technology companies, which dominate today's market, may genuinely deserve higher valuations due to their scalable business models. Additionally, improved corporate governance and financial reporting might support higher sustainable valuations. For practical application, think of CAPE as a market thermostat rather than a precise timer. When it's extremely high, like 2000's level of 44, be cautious about aggressive stock purchases. When it's extremely low, like 2009's level of 13, consider increasing your equity allocation. CAPE also helps with international diversification. Different countries' markets have different CAPE levels at any given time. You might find opportunities in markets with lower CAPE ratios while being more cautious in expensive markets. Remember, CAPE works best for broad market analysis, not individual stock selection. It's a macro tool for understanding market-wide valuation trends, not a microscope for examining specific companies. One important limitation: CAPE can be distorted by major accounting changes or structural economic shifts. The shift toward asset-light business models, increased share buybacks, and globalization have all potentially affected how we should interpret historical CAPE comparisons. Despite these limitations, CAPE remains one of the most reliable long-term valuation indicators we have. It combines the simplicity of PE ratios with the wisdom of historical perspective. By smoothing out economic noise, it helps investors see the forest through the trees. As we wrap up, remember that CAPE is best used alongside other valuation methods, not in isolation. In our next capsule, we'll explore how to combine different valuation approaches to build a more complete investment framework. Until then, keep CAPE in your toolkit as a powerful gauge of long-term market value.